Is the Amazon empire finally crumbling from the inside out? Revenue just surged 13.6%. Headline numbers look bulletproof. But behind that polished surface, there is a 12.8% gap between what investors are paying and what the business is actually worth. This isn't a rounding error, it's a structural fracture, and almost nobody is talking about it. Rewind to 2020. Jeff Bezos stood atop the leanest and most ruthless growth machine ever built. Amazon's balance sheet was a weapon. Minimal debt, explosive free cash flow, every dollar of spending returning multiples. That was the Amazon investors fell in love with. But the company standing here today is a different animal entirely, and the math proves it. When you run a discounted cash flow model, essentially a lie detector that strips away hype and measures only future cash generation, Amazon's fair value lands at $186.75. The stock trades above $210. The Graham number, designed by the father of value investing himself, is even more damning, $177.33. That's an 18.8% overvaluation gap. World-class companies often trade at a premium, but that premium is usually backed by accelerating efficiency and growing cash reserves. Amazon is showing the exact opposite. Investors aren't buying today's mathematical reality. They're buying the narrative of the last 10 years. That's not investing. That's momentum gambling. And the institutional giants and the smartest money in the room already know it. Amazon's price-to-earnings ratio compressed from 35.4 to 29.5 year over year. For those unfamiliar, PE measures how much investors will pay for $1 of future earnings. Normally, a lower PE means a stock is on sale. But context changes everything. When a mega-cap tech stock's PE drops sharply while the price stays elevated, that's not a discount, it's de-risking. The market is reclassifying Amazon from a high-growth rocket ship to a slower, mature utility. Even though earnings per share improved to $7.24, investors are paying less for each dollar of profit because they perceive higher risk ahead. A shrinking multiple in a growth stock isn't a sales sign, it's a fire alarm. So where exactly is the risk? Follow the cash. Net investing flows plummeted from negative $37.4 billion to a staggering negative $47.2 billion, a 26.2% increase in spending in 1 year. Billions poured into AWS data centers, fulfillment warehouses, logistics networks, and the still bleeding Rivian investment that has yet to deliver meaningful returns. Here's the critical distinction. If you spend a fortune renovating your house just to stop the roof from leaking, that's not growth. That's maintenance. Amazon is running faster just to stay in the same place. And how are they funding this sprint? By swiping the corporate credit card. Long-term debt surged 24.8% to over $65.6 billion. The debt-to-EBITDA ratio spiked from 112% to 140%. Compare that to the Bezos-era discipline of minimal leverage and relentless reinvestment from operating cash flow. The velocity of this accumulation is the real red flag. Organic growth is funded by your customers. Artificial growth is funded by your bankers. When a company leverages its future to fund present operations, it introduces fragility that didn't exist before. But the most damning evidence is what all that debt actually bought. Total assets exploded 30.9% to nearly $818 billion. You'd expect that with 30% more infrastructure, more servers, more trucks, profit efficiency would improve. That's the entire point of economies of scale. Instead, net margin declined from 10.7% to 9.9%. Picture an athlete packing on 30 pounds of muscle but running a slower race. That isn't muscle, it's dead weight. A 38% spike in other long-term assets points to massive, potentially illiquid bets that haven't paid off. Asset growth without margin growth isn't expansion, it's bloat. And here's the smoking gun that ties it all together. Receivables grew 22.1% to $67.7 billion. Revenue grew only 13.6%. Pause on that conflict. Receivables, essentially I owe us, where Amazon booked the sale but hasn't collected the cash, are growing significantly faster than actual sales. On the surface, it looks like rising revenue. In reality, it's a liquidity trap. Profit exists on paper but isn't sitting in the bank to service that $65 billion debt load. When receivables outpace revenue, it often signals customers struggling to pay or revenue being pulled forward to dress up quarterly numbers. Revenue is vanity. Cash is sanity. If the picture is this grim, why hasn't the stock collapsed? Because Amazon's operational heart is still beating. Inventory turnover improved from 9.01 to 9.30. World-class velocity. Their core retail engine moves goods off shelves faster than almost any company on Earth. This is the hidden safety cushion, allowing razor-thin margins while competitors drown. Without it, the debt and asset problems would have already triggered a crisis. But does the market actually trust this cushion? The price-to-book ratio answers that question brutally. It plummeted 21.9% to 5.57. Assets, the book, grew 30%. Yet the price investors pay for those assets dropped 20%. The market is voting with its wallet. These new assets aren't valuable infrastructure. They're dead weight. The company is getting bigger but less valuable per dollar held. So here is the verdict on the question we opened with. Amazon's headline $213 billion in revenue looks impressive. But this growth is engineered through a dangerous debt spike and asset bloat, not organic efficiency. Margins are declining, cash is trapped in receivables, and the smart money, evidenced by collapsing PE and PB ratios, is quietly pricing in a correction. Amazon's greatest strength remains its operational velocity, but its Achilles heel, the deteriorating balance sheet, is catching up. I believe within 3 years, Amazon will be forced to make the biggest strategic pivot in its history. Not another acquisition, a spin-off. They will shed a major non-core asset to pay down debt and restore efficiency. The era of endless expansion is over. The era of forced efficiency has begun. So hit subscribe so you won't miss what's next and jump straight to the next video, because that could be the very insight you need to get ahead.